Hey everyone, and welcome back. Today we're going to be talking about an options strategy known as the Iron Shark strategy. Cool name. So we can review what happened in 2022. It was quite a bad year for the markets, especially for equity indexes. So we're going to be evaluating together how this strategy performed in out of sample. Before we begin, though, as always, please, I encourage you to subscribe to our channel if, of course, you haven't already done so. Click on the notification bell and leave us a like to this video as well. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. So guys, one of the coaches at Unger Academy here, and today we're going to be talking about the Iron Shark options strategy. And I remind everyone that this is a delta neutral strategy that aims to take advantage of the passage of time, and it's Vega negative, so it benefits from a decline in volatility. It is designed for equity markets, especially the mini SP 500, whether it's futures or the index, but it can also be designed for high capitalization stocks as well. So in yellow, you can see the out-of-sample performance of the strategy from when it was released until today. You can already see that the in-sample phase, as is usually the case, we have a much more linear strategy than in the out-of-sample phase, which I'd say is positive. Although it is also true that for the indexes from 2010 through 2018, we have seen a very linear period with few market crashes, except for August 2015, when the market started to show signs of turbulence. Now, I'm referring specifically to February 2018, the October, November, December quarter of that year, the COVID pandemic, yes, as we all remember, and certainly also the current period, which is one of the worst starts of the year for equity indexes. Now, what is unique about the strategy is that into its core, it has this kind of protective mechanism against so-called black swans, those unfavorable events characterized by an abrupt decline in the underlying asset, and then at the same time, a sharp increase in implied volatility, which is often very damaging to option sellers. So this is a strategy that tends to protect itself during sharp market declines. Now, 2022 was special because we saw a drop in stock prices. But this is interesting. There was no real volatility explosion. Yes, we also saw that the VIX was at relatively high levels, but there was nothing like, for example, the values reached during the COVID pandemic or other events in 2018. And that is undoubtedly one of the reasons that we have seen a relatively large drawdown in the strategy in 2022, amounting to $8,000, which is much larger than the maximum historical drawdown that we've seen in the past. However, all in all, given that the stock indexes are still down significantly since the beginning of the year, I'd say that the strategy, which is still making gains and has recovered from this drawdown, has done quite well. And it is true that we've seen the most negative period for this strategy, but if we consider the performance of the indexes, I'd say that we can be very happy with the result. A result that amounts to about $2,000 gain since the beginning of the year. And also consider that trading this strategy on the SPX requires a margin ranging from $10,000 to $15,000, depending on volatility. But anyway, let's go back and have a look at the overall statistics of the strategy from its inception until today. The number of trades made by the strategy is 276. We've got a net profit of $109,000, a profit factor of 2.82, and a percentage of profitable trades of 75%. The average value of profitable trades is $816, while it's $866 for the losing trades. And of course, it's a negative value, so minus $866 for a total average trade of $395. Winning trades stay on the market for 17 days on average, while losing trades remain in the market for about 13 days. And as mentioned earlier, the historical maximum drawdown on closed rates is $8,165. So, we're looking at some interesting numbers, especially when we relate them to the margins that brokers charge for trading the strategy, as mentioned earlier, which range from $10,000 to $15,000, depending on the level of implied volatility. And here at Unger Academy, well, we try to let the numbers speak for themselves, and that's why we show backtests also on options strategies. So we don't just tell you about the operational structure and the different management rules, but it's also appropriate to do backtests on options strategies, such as we do on futures, to see how well a strategy has performed in the past and the present. And if any of you are interested in learning more about systematic approaches to the markets, we've got something for you. We'll leave you a link in the description, and it's a free presentation by Andrea Unger where he introduces you to his trading method, which he used to win the World Cup Trading Championships in real money trading 4 times. And you can also get, by covering just the shipping costs, the bestseller, the Unger method, or even book a free strategy consultation with one of our tutors. And guys, that is it for today. Please leave us a like if you like the video. Subscribe to our channel to stay updated on the release of all our new videos. Until then, we'll see you again next time soon. Bye-bye for now.